All right, everybody. So, welcome to this week's Huddle. It is lovely March 21st, 2022. We did have Lorraine on several months back, but I asked her to come back again because I know that she's been working really hard and putting out some webinars and really teaching this a lot since the last time we spoke. And so I want everybody to hear it again or to hear it for the first time. And I finally have some money that I can invest in mortgage notes. So I'm excited for you to be back. Last time I didn't have any money. That's why I got to bring you back so I can hear about it again. So Lorraine is an expert in mortgage note investing. And, it's not something that's, I think, taught by a lot of people and not taught well. So I give you guys Lorraine Millington, and Lorraine, you can take it away, share your screen, tell us a little bit about your story and your company and all that jazz.
Sure. So good evening, everyone, or maybe good afternoon, I guess, depending on where you are in the country. But my name is Lorraine, and my company is Melanin Homes. And what we specialize in is mortgage note investing. So essentially, if you are looking for competitive returns on your investment, the opportunity to become the bank and not necessarily own real property, then I certainly welcome you to listen to me for the next, I don't know, roughly 30 to 35 minutes. I'll take a high level overview on what mortgage note investing is, and then also break down some of the terms and information relating to the strategy. It might sound a bit wordy. I'm going to try to make it interactive as best as possible, but just ask for everybody to just to bear with me here. So I'm going to share my screen. This is always the technical part that gets me. Okay, and then presenter. Oh. Okay. All right. So mortgage note investing, that's what we're going to be talking about this evening. And really what it boils down to is learning how to become the bank in these transactions. Just a really quick disclaimer that I like to give. The information that's being presented, well, I put webinar, but it's a presentation by Melanin Homes is for informational use only. So Melanin Homes are not liable for any loss resulting from any action taken or reliance made by any investor or client based on the information that's going to be presented. And we make no representation or promise concerning the earnings or results to be achieved based on the information that's being presented. So I, just from a legal standpoint, just want to give all of this disclaimers. And just a really quick rundown of the agenda. So I have a few things that I want to discuss. First thing, we're going to go over what is a note. For those who, I believe all of us on the line here are involved in real estate, so we're familiar with that, but maybe not so much note investing. The different types of paper, and when I say paper, I'm going to get into this a little bit more in depth, but note investing is essentially investing in the paper versus the property of an asset. What are the benefits and challenges of note investing? How to get started? And then I do have a couple of examples. And then lastly, I would ask if maybe everyone could leave some of the questions until the end. I'll try to pause in between and maybe I'll probably be able to view the chat. But for the most part, if you'd be able to leave any questions to the end, I would appreciate it. And then lastly, if to have an open mind. I know, again, this is going to be a lot of information, maybe some of it a bit technical or things that you aren't used to. So I just ask that you have an open mind to be able to retain and accept most of the information. All right. So just kicking it right off, what is a note? So when we're talking about mortgage note investing and relating to the note itself, it is a piece of paper. It is a written debt instrument, which basically serves as an IOU between the borrower and the creditor. And this piece of paper, this written debt instrument, has this particular information. So it outlines the principal, which is the loan amount or the amount that's being borrowed from the financial institution. The interest, so basically the bank's profit, and then the term. Most of the time, or most mortgages are 15 to 30-year mortgages, but terms do vary. Now, When we're talking about notes and who potentially sells notes, we have financial institutions like the big banks, Chase, Bank of America, Wells Fargo, those types of places. But then we also buy notes, mortgage notes from credit unions, hedge funds, and even private sellers. So these are just some of the people that we work with when we're talking about mortgage note investing. And one of the key benefits of mortgage loan investing is that even though we are investing in paper, which is, I mean, it's technically a tangible asset, but when we're buying mortgage notes, we're purchasing the debt associated with the property and not the property itself. So that debt is an intangible asset. However, it is secured by real property. So when we think about other intangible assets, I mean, one of the biggest that's being talked about right now is cryptocurrency. You can invest in cryptocurrency, but you can't physically touch it. It's not secured by anything. Same thing with the stock market. These are just different options where you're investing in an intangible asset, but it is not secured by anything. With mortgage note investing, although it is an intangible asset because you are investing in debt, it is secured by the property. So you have collateral for your investment. So hopefully, so far, this is making sense. So as we talk about purchasing paper as an investor relating to real property, there are different types of paper. So I'm going to give some scenarios when we're talking about the different types of paper. Performing notes, non-performing notes, subperforming, and reperforming notes are just some of the terms and terminology that we use when we're talking about the types of paper that we're purchasing within mortgage notes. Performing notes, again, just to give you a scenario, someone is looking to apply for a mortgage, right? So they go to a financial institution or a credit union, what have you, and they apply for the mortgage. Once they are getting that mortgage is going to be basically outlined on a note. As the note investor, you are purchasing this piece of paper. This note, this promissory note, is in place to say that I promise, speaking as the borrower, I promise to pay back this certain amount of money, which was the principal, over this length of time, which is the term, at this particular interest rate, which is what we kind of just went over. As long as that borrower is continuing to make their payments, continuing to perform on their promise to make their payments, that is a performing note. And you, as the note investor, if you purchase this performing note, you now become the person that they are making their payments to. So instead of Chase or Bank of America or Wells Fargo or any of these other institutions, they are now going to, Bank of Brook or Bank of Sophia, whoever is the note purchaser of that investment. And now you are starting to receive what we like to call mailbox money every month, as long as this borrower is continuing to make their payments. Now, on the flip side of that, if you as a note investor are purchasing this piece of paper and the borrower, for whatever reason, is no longer making their payments, they are no longer continuing to perform on their promise to make their payments over the duration of time at the particular interest rate. So you and maybe some people might be asking, so, okay, well, I understand why I might want to buy a performing note. I'm getting money. It's basically like being a landlord without having to deal with the property. But some might be asking, okay, well, why would I want to buy a piece of paper that isn't giving me mailbox money, or I'm not receiving monthly payments? One of the strategies that people use when they're purchasing non-performing notes is the potential ability to pick up properties below market value. Now, what I mean by that is if you are purchasing a non-performing note and this person is no longer making their payments, you have a couple of options. You can, because you are the bank, you can, one, go in and try to modify that loan if it makes business sense. Because you are the bank, because you own the debt, you can modify the loan to maybe even extend the term, lower the monthly payment amount, that sort of thing, if you want to keep them in the property. The other option as the bank in these transactions when purchasing a non-performing note is to potentially foreclose on the property. again, we have to remember that we are the bank in these transactions. So if you have a performing note that is no longer continuing to perform, you as the bank have the ability to foreclose on this property to basically take back legal possession of the asset and then be able to sell it and recoup your investment. I know, and hopefully I'm not going too fast, and this is starting to make sense as I continue. Now taking it to some, I guess, lesser known terms in terms of subperforming and reperforming notes. Really quickly, subperforming notes go along more of the lines of the performing notes. Subperforming is just essentially the borrower is making their payments, but maybe they're not making them consistently. So maybe they make their payments every 4 months and then maybe skip a month and then pick up another few months. That would be considered a subperforming note. A reperforming note goes more along the lines of a non-performing note. So taking it back to the example that I gave, if you purchase a non-performing note and you as the bank want to go in and now modify this loan, if you modify the loan and the borrower now starts to make back their payments and make them consistently, now that is a reperforming note as opposed to a non-performing note. So, okay, I'm just, because I do think that that was a bit much. So what I want to do is I'm just going to pause here for a second and just take the pulse of the room. If everyone could maybe, I think I can see the chat. If everyone could leave me like a 1 in the chat box, I want to just make sure that we're still kind of moving along here. I've got the thumbs up. Okay, perfect.
That means they're not all asleep yet.
Right.
But hopefully they understood all that.
I want to make sure that the blood is still flowing there. Okay. So now we have an idea of what a note is. We know the different types of paper that we could potentially purchase as a note investor. Now, why would these be attractive? I sort of touched upon some of these, or what are the benefits of investing in notes. And I did touch upon this when I was going over what a performing, non-performing note is. But some of the benefits, in my opinion, of note investing is truly passive income. Coming off of the market that we were just in terms of foreclosure moratoriums and eviction moratoriums and things of that nature, where landlords who are still responsible for the maintenance and the day-to-day aspects of the property weren't getting paid by their tenants. In a note, I bought a couple of notes actually during the pandemic, but it is truly passive income, especially if you are purchasing a performing note. This money is coming in monthly like clockwork, because like most people that pay their bills, they're going to be paying their bills monthly. Because you are purchasing a performing note, because you are the bank in this transaction, you are not concerned with what, you're not worried about trash, repairs, or toilets, tenants, anything like that, because all you're concerned with is receiving your monthly payment on time, because you are the bank. The homeowners that are on the line, you don't call the bank when you have a leaky toilet or when you need to take the garbage out. You do that yourself. And it's the same situation as a note investor. You basically sit back and receive monthly payments as the bank. Also, another, in my opinion, benefit of mortgage note investing is retirement, being able to grow your retirement. I think most of us on here are entrepreneurs, and so we're always looking for ways to build that nest egg. So one of the possibilities within note investing is to be able to purchase within a self-directed IRA or a solo 401k, that type of thing. And the reason why we want to maybe use one of those accounts is because of the true passiveness of this type of investment. It's really like a set it and forget it type of situation, or it can be close to a set it and forget it type of situation. So it really lends a great opportunity to be able to grow your retirement accounts. Taking it back to non-performing notes and the possibility to foreclose on properties, take back possession of them, and then sell them to a wholesaler or a cash buyer or something like that. Investing in notes, investing in mortgage notes, can provide you with the opportunity to build your portfolio. Most of us who are in the real estate market are dealing with the bidding wars that are going on for properties at the moment. So why not potentially eliminate that, kind of come in from the back door and purchase a note, especially a non-performing note, and give yourself a better opportunity, or a better opportunity to be able to pick up properties under market value. So this could potentially be a portfolio building strategy as well. In addition to, you have multiple exit strategies. So let's just say in a scenario, you purchased a non-performing note and you go through the process to potentially take this property through foreclosure, and through the foreclosure process, you end up keeping the property. So now it becomes an REO, or a real estate owned property. As an REO, you have plenty of options. You now can, again, sell this property to a wholesaler for cash, sell it as is. You also have the opportunity to maybe rehab the property and then sell it to a retail buyer. Or you can do a buy and hold. You can create your own note after you own the property and be able to then maybe seller finance or create a lease option for another borrower. So there's multiple exit strategies, and I'm only touching on a couple for the purposes of this presentation, but there are multiple exit strategies that are available depending on the type of note that you're interested in. And then maybe one of my favorites is the ability to work from anywhere. Because this is more of a paper strategy, I can do a lot of my due diligence and my research from my computer. So the flexibility of not necessarily having to go out to a property and look at it and do the scope of work and all that stuff is really something that's appealing to me when investing in paper as opposed to property. Okay, so those are some of the attractive benefits, in my opinion, of note investing, but I thought it only fair to mention maybe some of the challenges to mortgage note investing. So some of the challenges, in my opinion, is this is a longer term strategy. So for some of the wholesalers or the flippers, the rehabbers that are on the line, this does not turn around overnight. So if you're a wholesaler and you're looking to, put something under contract and then sell it to the next person by tomorrow for whatever the wholesale fee is, this is not necessarily that type of strategy. It is a longer term strategy because, like I mentioned before, you can build your retirement account, but then also if you're purchasing a performing note, you are receiving that money over time. So just think about how long some mortgages are. When we're purchasing these notes, we are purchasing them secondary. So on the secondary market, we're not originating a lot of these loans that we're purchasing. So because we are purchasing them on the secondary market, there is the opportunity that maybe there's 10 years left or 5 years left on the loan. I don't want to give the impression that with purchasing mortgage notes, you're going to be locked in for 15 or 30 years. That's definitely not the case in every situation, but I do want to emphasize that if this is a longer term play, whether you have performing notes and you're receiving your money over time, or it's a non-performing note where you potentially either are negotiating with the borrower to modify the loan, or you have to go through the foreclosure process, because depending on what state you're located in, that process can take some time. Just to kind of give you an example, I'm located in New York. I live in New York. And to take a property through the foreclosure process in New York, you should be prepared to at least wait about a year or 2 years. And that's if everything goes smoothly. So this is just something to keep in mind if you are interested in note investing. Just because it's a longer time doesn't mean that you still won't reap the rewards. It's just something to be prepared for with this type of strategy. One of the other challenges that I would say to investing in mortgage notes is the kind of the mindset shift that we are investing in the debt of the property versus the physical property themselves. So when we're investing in notes, even if it's a non-performing note, we can't just go up to the house and kind of walk around and do that type of thing, because we don't own the property. We own the debt. And so owning the debt allows us control over the property, which is great. We just don't own the property. And so for some people who want, at least not initially, I've already mentioned what the process would be to take back possession of the property as a non-performing note. But for the most part, initially when we are purchasing notes, it's really associated with the debt instead of the physical property. And why that's important is it leads me into the tax benefits. So going back to either being a rehabber or a buy and hold type of investor, with those strategies, especially with the buy and hold type of investment, you have numerous tax benefits, whether that's depreciation or appreciation of the property. And those definitely factor in over the life of the investment. Because with mortgage note investing, we are investing in the debt and not the property, we don't have those particular tax advantages of depreciation or appreciation. It's not to say that we can't offset the profits and the revenue and the income that we're making from mortgage notes with a rental property to kind of offset that income. And I have a tax background, so that's where my mind goes. But I wanted to mention that just to point out that for those who might be debating between buy and hold and mortgage note investing, it's not to say that you have to stick to one or the other, but this is just something to keep in mind in relation to this strategy. Okay, guys, so I'm going to take another quick pulse just to make sure that we're all good. Thank you.
Lorraine, can I ask you a quick question?
Yes.
You might be getting into this, so if it's coming up later, that's fine. But going back to this just being a longer term strategy, and if you're buying, let's say, a non-performing note in the hopes of foreclosing on it and taking it over, I would assume there are states that are better to do that in. So are you going to talk about the different types of states and investing in notes?
So I didn't want to overwhelm everyone with all the terminology, but I can touch upon that right now. That's a great question. So essentially what you're referring to is whether you would be interested in investing in a judicial state versus a non-judicial state. And essentially what that means is that if you are investing in judicial states, some of those being Indiana, Florida, Illinois, like those are some of the those are some of the judicial states. Essentially what that means is that if you are going through the foreclosure process, if you have bought a non-performing note and you want to take back legal possession of that property, in a judicial state, you have to go through the court system in order to initiate that process. So when we're talking about the length of time that you may be in an investment, if you are in a judicial state where you have to go through the court system, and based upon what we just came out of in terms of the pandemic and everything being backed up and yada yada, this could extend the amount of time that you are in the investment if you are in a judicial state. Now, it's not to say that every judicial state takes forever. A lot of this is county specific. Some counties move a little bit quicker than others, but it is something to keep in mind overall in terms of your investing. Now, the flip side to that is investing in non-judicial states. Some of those being Michigan and New Hampshire, and I want to say Connecticut, I believe, is a non-judicial state as well. So when you're dealing with a non-judicial state, you don't have to go through the court system to be able to initiate the foreclosure. So that can sometimes expedite the process of taking back legal possession of the property. So yes, when I talk about longer term strategies and depending on what state you're investing in, these are some of the things that we factor in. Now, it's not to say that just because a note is in a judicial state that I wouldn't invest in it, because I actually have two notes in judicial states. There's more that factors into it, whether or not there is a redemption period, which essentially means that if this property were to go to foreclosure and not sell at foreclosure auction, and now I take back legal possession of the property, if there is a redemption period in place, that allows the borrower a certain amount of time, again, dependent on the state. Usually it's like 6 months to a year for the most part, depending on the state, but it allows the borrower that amount of time to now come back and pay their amount in arrears and the penalties and the interest and all of that. And then as the investor, yes, you are made whole, but then you don't get the property. So, I mean, you take, it's not a bad thing because your investment is still protected, but if you had your heart set on that property, it might not work out in those situations. So these are a lot of the things that as we evaluate note investment, these are a lot of the things that we take into account. So yes, thank you for that question. Maybe I should add another. I just I didn't know how in depth to go, but that's something that I touch upon in terms of the longer term strategy of how it can take long versus maybe not so long in other situations. So hopefully that made sense, and that was a perfect time to ask that question because yeah. Because now I want to kind of touch upon so I shared a lot of information, and maybe some people on the line might be liking what I'm saying. Maybe they're like, I don't want to deal with it. But for those who may be interested in wanting to know, like, how could I get started with something like this? I've been, dealing with tenants. I don't want to deal with tenants anymore, but I still like the idea of having passive income. Or, I've been struggling with trying to, get a property under contract to rehab, but these distressed prices are not very distressed. So if you're interested in maybe, diversifying your investment portfolio with something like notes, and you're interested in how to get started, what we see here on the screen are some of the things that I would suggest having in place. So first, all of us are already in real estate. I think most of us are from that company. So I believe we all have a legal entity in place already. So it is strongly recommended that if you are going to be investing in notes, to have a legal entity in place, whether that's an LLC or whether that's a self-directed IRA or whether that's a solo 401k, because, and I'm going to continue to harp on this, when we're investing in notes, we have to keep in mind that we are the bank. And so we want to maintain that professional, separate stature. And there's a lot of compliance and regulation issues in place as well. So it's strongly recommended to have a legal entity in place. And then of course, capital, right? Like we need the money to be able to invest in these notes. Now it's different than maybe some of the other strategies because we don't really finance notes. It's either you have the amount or you don't. Now, there are different sources that you can use to potentially fund your investment in a note, whether that's, cash is king, as they say. If you have money in a self-directed IRA or a solo 401k, you can absolutely use that income or the amount in that account to be able to invest. Now, one thing that I like to mention when I talk about self-directed IRAs is that for those who have, had, jobs in the past, and maybe you left the job and now you started a new one, and you had, sorry, this is New York music here. And maybe you had a 401k at a previous job that maybe you didn't roll over into your current employer's plan. That amount that you have in your old job's 401k could be used, and you could roll over the full amount. So regularly you have a limit, I want to say of 6,000 or 6,500 annually that you can contribute to a self-directed IRA. Now, for most people, I mean, that's not going to really, especially if we're talking about notes, that won't necessarily be able to buy you a note. But if you have an amount in an old 401k, you can roll over that full amount into a self-directed IRA and potentially give yourself another opportunity or another resource to be able to use to invest in notes. So that's just my little spiel about capital. Boots on the ground. So similar to what I mentioned about being able to work from anywhere and not necessarily having to go to each asset that I might be analyzing or evaluating to see if it's something that I want to get involved with, I have boots on the ground. I have a team in place in the various locations where I'm investing to be able to do comparable sales, to give me pictures and estimates of the asset, to be able to check for taxes and liens and all of these things. Basically, providing support for the due diligence that is necessary for these types of investments. In order for me to be able to do that in locations all around the country, I have boots on the ground to be able to assist me with that. So I don't physically have to go. which continues to play into the whole passive nature of this type of strategy and this type of investment. And then, of course, another key part or key piece of being able to get started is the inventory. So where can you get inventory? Most of the inventory, again, comes from banks, credit unions, hedge funds. We do have, people who do seller financing and they create their own notes. That is also an opportunity for inventory to be able to purchase notes. But this, just because these institutions have this type of inventory doesn't mean that they're just readily selling these assets to everyone who comes off the street. These are generally, this type of strategy or this type of investment is generally geared towards, that's what I was looking, geared towards accredited investors. And so for most people who aren't accredited investors, it can be a bit of a struggle to be able to get access to actual inventory, because these banks, they're in the business of lending money. They don't necessarily want to hold assets on their books, but they're also not just going to sell them to someone who they don't feel has the ability to close and close consistently. So if you're not an accredited investor, and maybe if you don't already have relationships with these banks and these credit unions and these hedge funds, it is my strong recommendation to partner with someone who's already done this legwork. Partner with someone who has already established these relationships with the banks and with the credit unions and with the hedge funds that has active inventory that you would be able to purchase. And then you as the investor don't have to feel pressured into purchasing a whole pool of tapes, or excuse me, with the terminology of usually how we receive investments is a tape. So you don't feel as the investor that you have to buy 5, 10, 15 notes at a time just to be able to establish that relationship with the bank, if you already are partnering with someone who's established that for you. And I will say, I guess just a little plug at this juncture, I have partnered or I have affiliated with myself with these types of sellers, with the banks and the credit unions and the hedge funds. So if someone is interested in potentially getting started with mortgage note investing, and maybe just even the aspect of trying to network with the banks to get inventory is overwhelming, I certainly welcome you to join my joint venture program, my joint partnership program, where a lot of this is taken care of for you, and you have a resource and someone who's experienced and knowledge in this space to be able to get you started with notes. So that is definitely an option for those who might be interested and just not really sure which way to go or how to get started. All right, so I'm going to get into some examples right now. And I generally always give this as an example because it's my first note. So I'm very, proud and happy of this note. So this is a performing note, and it is a note that I have in Marionette, Wisconsin. I've never been to Marionette, Wisconsin. I don't plan on going to Marionette, Wisconsin, but I didn't have to, because I had the systems and I had the structure in place to get me enough information for me to be able to purchase this note and still own the note. So I don't want everybody on the line to get married to these numbers, because this is not going to be the situation for all the notes. But for this particular note, I was able to purchase this for around $10,000. The unpaid balance, or the amount left on the loan at the time that I purchased it, was $32,759. So doing the research, the as is value. So at the time, I've had this note for, I want to say maybe almost 2 years now. At the time that I was evaluating the note, the as is value of it was $40,000. So that the value, if I put no work into it, the value of the property supported the balance that was left on the mortgage. And even better than that, it was more than what I was purchasing it for. So regardless of what happened, whether this borrower continued to pay me or didn't continue to pay me, I knew that my investment was secure because the value of the property was worth more than what I was actually spending on the note. So since this is a performing note, the monthly payment on this particular asset is $558. So roughly, it's about a 40% cash on cash return at the moment. Again, please don't get married to these numbers, but I did want to just show you some possibilities. So that's a performing note. I do have an example of a non-performing note. So this one is in Royston, Georgia. And this one's a little bit more. So these numbers that you're seeing here are roughly more along the lines of what we would see when investing in notes. So the purchase price for this particular note was $27,776. And the reason why the purchase price is $27,776 is because, as you can see, the unpaid balance, or the amount left on the loan, is $55,553. Generally, how some pricing works, especially when it comes to non-performing notes, is we are generally going to get a bigger discount on a non-performing note because there's usually a bit more going on with it. Maybe there's back taxes, maybe there's some liens, because it's generally safe to assume that if they aren't making their mortgage payments, more likely than not, they're not paying the taxes either. And so the likelihood of having to clean up a couple of things to be able to protect to protect your position in this asset is key. So purchase price was about 28, unpaid balance was about 56. The as-is value, and I always focus on the as-is value because I'm just looking for the worst case scenario. So if I had to do nothing else to the property and I ended up taking back possession of it, what would my numbers look like? So that's why I focus on the as-is. And so the as-is value in this particular situation was $75,000. So if I had to take back possession of this property at a wholesale, my return on investment, or my ROI, would be about 85%. If in purchasing the note, I modify the loan, and so now this asset now becomes reperforming. And remember, I kind of went over the explanation for that earlier. And then it becomes a reperforming note. Now my return on investment is 58. Am I disappointed? Maybe a little bit, but I mean, how disappointed can you be in a potential 58% return on investment because they're paying you? I mean, most times, yeah, you could be upset about getting payments because in this situation, maybe you were banking on getting the property. But again, just wanted to outline just some of the numbers as we look at these investments. I think that, yeah, so that's really kind of sums up what I was going to speak about today. And one thing that I should have mentioned earlier, I did mention that we are purchasing these notes secondary. So we're not originating loans. And for the most part, the notes that I purchase, we are in first lien position. So that basically we're securing ourselves as the giving us the greatest opportunity to be able to recoup our investment if something goes awry. So you do have different positions. You have first position, second position, that type of thing. But I want to say 95% of the notes that I look at are first position liens. Okay, so I think that I probably bored everyone to death for the most part. But if I can clarify anything more that I discussed here during this evening, I certainly welcome you to reach out to me on my website. You can schedule a free consultation and maybe we can speak one-on-one about your particular situation, or maybe some concerns or some questions that you have relating to your specific situation and note investing. So you can certainly go to my website, melaninhomes.com. I'm available on all of the social media platforms, Facebook, Instagram. I didn't put LinkedIn, but it's all under my company name, Melanin Homes. Or, you know, if you're not necessarily ready to meet with me in person, I know sometimes that can be a lot, you can feel free to send me an email if you have any questions relating to what I discussed here today. And with that, I welcome questions from anyone.
So I see Brooke has her hand up, but real quick, Brooke, Steve had a question that came in through the chat from
Okay.
earlier. So regarding legal entity, should you have a separate legal entity rather than just like your active income LLC for those of us that are actively like fixing and flipping or whatever? Should the notes be in a separate LLC?
It really depends on what kind of note you're purchasing. I mean, performing notes are a bit more passive. So maybe if you're already doing buy and holds, I would probably put a performing note in that LLC if you just have one for that. If you're interested more in non-performing notes, that has the greater possibility of being more along the lines of like a flip type of thing. So I probably have a separate entity to hold non-performing notes. So it really depends on what kind of note you're interested in purchasing, would be my opinion.
Cool. All right, Brooke, what's your question?
Thanks for your presentation, Lorraine. You made it very easy and did a good job of explaining everything. So my question is, how do you determine how a note is as far as the redemption period?
Maybe I'm sorry, maybe I don't understand the question.
You said some of the notes have a redemption period in them. How do you determine which ones do and don't, and how do you find that out?
Oh, sure. I mean, I have basically a listing, and I mean, to be honest, it's just really Google. Some of they're really all compiled. I think I have a list on Nolo. Should really probably separate that list. But essentially just Googling judicial versus non-judicial states will give you a lot of that information, because there will be a map or a listing of the different states, and then it will say whether it's judicial or non-judicial, and then it will also provide the redemption period.
So typically a redemption could fall into the judicial states, is that?
Oh yeah, absolutely. You can have redemptions on judicial or non-judicial, and then there are some states that don't have any redemption at all. So taking it back to New York. So I did say, so New York is a judicial state, and the length of time that you would be in a foreclosure can be anywhere from a year to 2 years, but they have no redemption. So yeah, most of your time is spent up front through the foreclosure. But once the foreclosure is done, now you're good. So those are just some of the factors to pay attention to. And that's why I say, like, just because it's judicial, you can have to maybe go through the court system, but maybe the judicial time frame is only 3 months, and then there's no redemption period. Like I want to say Texas. Texas is a judicial state, but their foreclosure process from start to finish is like 60 days, and there's no redemption period. So you know what? Maybe judicial isn't as, it doesn't, I don't want to give it the impression that judicial is necessarily a bad thing. There are just other factors to keep in mind.
Okay, thank you.
Sure, thank you for your question.
I have a question, but I don't know how to raise the hand in the Zoom thing. I don't see a little hand button.
Well, you're on the mic, so go for it.
Okay. So I'm not clear on where it originates. In other words, do I find a property that I think, hey, that would be a good one to buy a note on? I see it come up on auction.com, where I see the notice of default at the courthouse, and I want to say, I want to grab that note before it goes to auction. Does it start on me on my end, or are we going to some secondary, like you mentioned, a secondary market, and they put a list out and we just look down the list and find ones that we think might be good? Which how's it go?
Sure. So a lot of this is a relationship business. So you're not going to see, well, I shouldn't say you're not going to see notes on like auction.com, because you do have, some players that are selling things that they don't even really own. When you're selling debt, you are the lien holder, and not everyone is in that position. So talking about trying to get something before it goes to auction, that's a bit challenging unless you know the original lien holder, or I shouldn't say the original, but the current lien holder. They're the only ones that would be able to sell that lien. Now, if it goes to foreclosure and then there's a foreclosure auction, yes, those properties are going to be listed on that foreclosure auction list, and maybe you do a little skip tracing and all these other things, maybe look in the public records to see what deed has been filed and all of that, you would be able to get the name of the entity that is the lien holder, and then skip tracing that name to get the actual person. That's the process that you would have to go to if you're trying to do the back end type of situation to pick up notes. You do have some online platforms, Bigger Pockets, Paper Stack, Notes Direct. These are platforms geared towards note investing. So you would be able to go on there, and they generally just have a listing of the notes, and then you would have to know what part to do in terms of due diligence and being able to investigate the note. But essentially, there's not outside of the online marketplaces that I mentioned, and outside of having a relationship with some of these loss mitigation managers, asset managers, those types of people, it would be challenging to be able to say, I'm just going to go buy a note, because again, it's the debt associated with the property, and finding the lien holder that owns that owns that debt might be challenging, especially if it's an individual. Does that make sense?
Yeah, that helps. And so in developing a relationship, should I go to some of the bigger banks in town or smaller and try and talk to their managers or their vice presidents and say, hey, I'm interested in what you have to sell. Can you put me on your list?
Sure. And that conversation might not go as smoothly as you know, that role play, but a lot of times these banks are going to want to see your collateral. They're going to want to see what you have in the bank. They're going to want to know that, okay, I'm just not showing you my inventory just to show it. They need to know that you're going to close, and that you're going to close consistently. So if you, I'm not trying to deter you from having those conversations, but just be prepared to kind of, for lack of better term, kind of put up or shut up type of thing. Like, they're going to want to know that you're serious. And then, and on top of that, you're not going to necessarily be able to cherry pick which notes you want to purchase. If you're going to these banks and you're saying, hey, I want to see what you have available, I want to purchase your notes, be prepared to purchase that tape. Be prepared to purchase that pool, because they're not selling one-offs unless you already have a relationship with them. Okay. So those are the things that I would say be prepared for if you want to go direct to seller.
Thank you.
Hopefully that helps.
Yeah.
So Lorraine, how do you do the research to know that you're buying a first position versus second position note? Is that
So a
something
lot of
like
times,
with title?
yeah, well, we're definitely checking title generally further along in the due diligence process, but a lot of that information comes from the seller. So I'm not really displaying it right now, but when you get a tape, you have certain information. You have the address, you have, sometimes they'll mention whether it's a performing or non-performing. You take that with a grain of salt. It's more so in your research when you can determine whether or not it's a performing or non-performing note. But yeah, a lot of that information will be there, and you know what sellers have. So sellers, like especially these big box, like the banks and the credit unions and the hedge funds, they generally only have first position. Not to say that they don't have second position, but a lot of the second position liens are going to come from individuals. They're going to come from maybe the smaller credit unions, or maybe the smaller hedge funds, or the private sellers who, okay, yeah, I purchased this second mortgage at pennies on the dollar, and maybe now I want to sell it. But those are few and far between as opposed to first positions, because you need to take out, well, you don't need to, but most people take out a mortgage to purchase their property. Not everyone is taking out a second mortgage to take out their home equity line of credit or these other things. I do think we will see an increase in that because of the phantom equity that we're seeing now, because of the bidding wars and the home values skyrocketing up. I do think we will start to see more second mortgages on the market, but that's another presentation. We'll talk about that another time. So yeah.
Lorraine, so how does it work joint venturing with you? Do you buy like the tape of these properties and then you off-sell them for like a commission or a percentage, or how's that work?
Yeah, so how I do my my joint venture, joint partnership program is that I am partnering with, did I stop share? Maybe.
No, I did it so we can see each other and talk to you.
So essentially, I have access and I get inventory monthly, really every couple of weeks, but monthly. And I actually just got some inventory in a few hours ago that I haven't even really been able to look at yet. So I get inventory tapes from the sellers roughly on a monthly basis. And if I am working one-on-one with an investor, and I have a few people that I'm already working with at the moment, but we are basically doing a deep dive. What I'm doing is I'm meeting with you pretty frequently to initially get your criteria. And this is a bit of a process, but I need to know as we're working together what you're looking for. Maybe what's your budget like? Maybe I'm more interested in performing versus non-performing. We hash all of that. We get your criteria narrowed down. Once we have your criteria, then we start going through and I show you the process of how to do the due diligence and how to do the research on a property. So I'm basically taking you from A to Z in the purchase of a note. And it's really the opportunity for someone to be able to learn while they're earning income through the note investing program. And I can certainly speak even more specific with you if it's something that you're interested in, but essentially it's a coaching / mentoring of being able to invest in notes. And the idea behind it is that if you're working with me throughout my program, you will eventually, if you want, be able to kind of purchase these notes or be able to do these due diligence tasks on your own. So then I could basically just, let you fly and let you release you into the note world. But essentially, you can partner with me initially just to be able to understand what you're doing. And then once you feel comfortable enough to be able to purchase notes on your own, then we can start to have that conversation as well.
Do you have to be accredited to work with you?
No, that's the whole point, because I realized that, this strategy or this industry has been designed for the big boys, if you will, or for the accredited investors. So because I have the ability to allow investors that work with me to cherry pick, so you don't have to feel obligated to buy 5, 10, 15 notes going direct to the seller, to the banks. You can have the opportunity to work with me and be able to purchase 1 or 2 investments just to be able to kind of get proof of concept and test the waters. You don't have to feel obligated to purchase a large amount of notes. Now, can you become accredited as you continue to purchase more notes and compound that? Of course. And that's really the idea and the design behind it, is for people who aren't accredited to be able to get their feet wet in this type of strategy and maybe get their way onto accreditation through this if they want. But no, don't have to be accredited. And actually, I shouldn't say don't, I would prefer some, if you are accredited, don't think you can't reach out to me. Please still reach out if you are. But don't feel like you have to be accredited to get started.
Thank you.
Sure, thank you. I think I didn't have the screening, but whoever asked that other question, thank you for that as well. So,
any other questions, guys?
Sure,
All right, Steve, do it.
if I can. When I first started this meeting, in my mind, I was picturing, buying a note. Okay, that meant, I'm going to be paying $300,000 for this note that's at 3%. I'm thinking, why would I buy a $300,000 note at 3% like a typical mortgage? How is that better than being a private lender or flipping? And then Lorraine, you show the picture of how they're discounting, and you're only paying 20, 40, 60,000 for something. Can you explain that a little bit better, how that works?
Yeah, and the range of notes definitely varies. I did show in my examples here some of the, I guess, lower end notes, but yes, you do have the
Call them
ability.
affordable.
Oh, there you go. I like it. I like it. Some of the more affordably priced notes, yes, you have that ability, but keep in mind that a lot of these are not, they're off the secondary market, so we're not originating these. So these 3 and 4% interest rates that we're seeing, this is right now. So these are notes that we're probably going to see in maybe the next 3 or 4 years. So just to give a little bit of context, banks, again, make money off of lending money, not necessarily holding on to assets. So when a bank originates a loan, they're more than likely going to hold on to that for at least the first 3 to 5 years, because all of those payments are interest. So they make a lot of their profit up front. Then they go and sell the note for a lump sum to an investor, because there's still tons of meat on the bones. So I'm basically just mentioning this to say, from the loans that I have seen, a lot of them I rarely see, and this is dependent on the borrower too, but I rarely see like 2 to 3% interest rates. I'm generally seeing 6 to 8 to even 10% of an interest rate. And even if it is a low interest rate, even if you are purchasing a $300,000 property for, a $300,000 balance for a 3% interest, this is compounding over time. You're not just getting 300,000, you're getting probably closer to 450 or maybe even 500,000. And you're sitting back just waiting. Like, what did you really, I shouldn't give the impression that you don't do anything, but I mean, essentially you're not having to really be active in the property to get that type of return. So even if you put this into a retirement account and just let it compound, that's the definition of passive income. So I know those numbers might sound low, 300,000 at 3%, but over time, I mean, I think it's something that's worth it. But we have what I am evaluating these assets. I mean, we have a budget sheet. So if the 300,000 at 3% interest doesn't make sense, then we don't purchase it. And I have a pretty robust budget sheet. So the numbers at the end of the day still have to make sense, even though it's passive. So hopefully that answers your question.
Yeah, thank you.
Sure, thank you. Have I stumped everyone at this point?
No, I mean, I think I like even what you just said in the beginning of that, which is basically, you know, we all have a mortgage. We know that the first however many years, it's really, you're just paying a bunch of interest, right? You're not paying anything down to principal. So it does make sense that in, 3, 5, however many years that the bank will sell that at a discount. They've already made their money up front. They're willing to sell it at a discount.
And there's still so much meat left there.
It's probably hard to see my hand because it's part of it with the background.
Oh, sorry.
But, no. I was looking at it and I was like, okay, my hand's blending. But my question is, it's like when you talk to the person who owns the note at the time, and you have that conversation with that person, what is that conversation like? Why do you tell them that you're calling?
So, and maybe to just help me understand the question, in what context are you speaking? Are you speaking in terms of trying to go direct to seller in terms of getting inventory? Or are you talking about trying to, if you bought the note and you're trying to negotiate the amount that needs to be paid? Is that what you're referring to?
No, I didn't know what I was referring to until you asked me the clarifying questions. But so
I just want to make sure I answer it correctly.
Okay, so I'm not really involved with the person who owns the house.
Right.
I'm getting the notes from other people.
Correct.
So, okay, I have your note. So then what does the owner know? I'm talking about if they're performing. What does the owner know that they just like our mortgages change or sold to other people or other companies, is just like that with investment?
So that's a great question. So essentially, again, keeping in mind that we are the bank in these transactions, it is strongly recommended that if you are going to be purchasing notes, that you hire a servicing company. Think of a servicing company similar to like a property management company. And so that servicing company is the go-between. They are maintaining communication with the borrower and they are maintaining communication with you. You do not, as much as you do not want to communicate with the borrower. There are, SEC and all of these CFPB, all these different acronyms of organizations that have regulations in place to protect the consumer. Even though we are individuals, we are still the bank. And so these regulations that are in place are to prevent banks from, harassing or going after borrowers. And so we have to basically play in that same lane. So we, as the known investor, are not communicating with the borrower. And so when a note holder sells, so let's say a hedge fund sells the note, the servicing company that is servicing that company will send a letter to the borrower and say, hey, your loan, I'm sure most people have gotten this type of letter, your loan has been sold to whoever else company. And so this is another reason why you want to make sure you have an entity in place when you're purchasing these notes. Because think about how you would feel if you own a mortgage and now you get a letter in the mail saying, hey, your mortgage, your loan was sold to Lorraine Millington. What? A person? Huh. I don't know if I want to pay that person my mortgage. Maybe I'll go look them up. Maybe I'll go Google them. Maybe I'll go skip trace them and find out where this person is. And you don't want any of that. So again, hiring a servicing company to make sure that that communication is separate from you with the borrower. And then again, having that entity in place. So you stay anonymous. Nobody needs to know who you are in the transaction, but the borrower is made fully aware of what is going on in the situation, who they need to make their payments to, and all of that stuff.
Okay, now it makes a lot of sense to me. Thank you.
Does the borrower get your entity information as well as the servicing company, or do they just get the name of the new servicing company on where they're going to write their checks?
So there isn't generally going to be a new servicing company. There's still going to be, well, if the old seller used that servicing company, then maybe. But let me see if I can give an example. You are the original lien holder, and maybe you had ABC company as your servicing company, and now I am buying the note. So, and maybe I'm using DEF servicing company, right? DEF servicing company will communicate with ABC servicing company to be able to get all of the documentation and all the records that have been made this note since the original lien holder purchased it. So yes, the borrower will get a letter from the new servicing company saying that your loan was sold, but it would have my entity's information as the company or the organization who purchased the loan.
Yeah. Okay.
It's what banks do all the time when you refinance or get a mortgage and they sell it off to another one, right?
Yep.
Yep. So we want to buy that paper if it's good paper. You know, we don't buy bad paper. Yep. I'm happy for all the questions. This is good. These are good questions.
Sweet. Anybody else? Go, Steve.
Has another.
Yeah, you kind of already answered this, but I think I need a bit more on it. If I do find something or properties that are coming up on auctions, and I'm able to find out who posted the notice of default, and who the trustee has been transferred to, like the attorney to hold the foreclosure. Can I contact them directly and say I want to buy the note, or is this something that they don't even have the ability to respond to? Do you know about that, or is it something I just have to ask?
So depending, and this is again dependent on the state, there are some states that will allow redemption of the amount due up until like the day before foreclosure auction. There are other states that after a certain point of time, there is no ability to pay up what is owed, and it just has to go to auction. And if it sells at auction, that's it, unless there's a redemption period, or if it doesn't sell at auction, then it goes back to the lien holder as an REO, and then they can sell it. So I'm sorry to say that it's not really, I guess, a specific answer, because it really does depend on the state and maybe even sometimes the county in terms of what they allow relating to when that amount that's in arrears can be paid, if it can be paid after a certain point. But I mean, it is an option, and I've even heard of people. So I even heard of people who own the note going to the foreclosure auction to be able to pick up the property, because they know it's probably such a good asset that they don't want it selling at foreclosure auction. They want to be able to retain their interest in that investment. So there's various strategies and ways to kind of maneuver and get clever in relation to trying to pick up notes. Yep.
So would this be easy to get stung, or is it all depending on your evaluation of notes ability?
Everything boils down to due diligence, right? And knowing how to do the due diligence on these notes and what to look for and what to pay attention to. So yes, I would say, I mean, of course, there's risk in everything, right? But when we're purchasing these notes, it's calculated risk, because we are doing a very detailed, at least if you're working with me, we're doing a very detailed search in relation to the asset and what we're looking at. So can't, and let me not say, I don't guarantee anything, and we can't predict what's going to happen, because what I often say with notes is the beauty in notes is the flexibility, and sometimes the not so beauty in notes is the flexibility, because a performing note can turn non-performing at any time, and a non-performing note can somehow win the lottery, or find money somewhere and now become a performing note again. So when we're evaluating these assets based on the budget sheet that I'm using, we are evaluating it based on each scenario, based on each exit strategy. So if it turns out to be cash flow and we're okay with those numbers there, great. If it turns out to be a wholesale and we're okay with those numbers, perfect. If it turns out to be a rehab and we need to sell it retail and those numbers make sense, awesome. But I like to make sure that depending on what could happen, if I'm okay with those numbers, worst case scenario, then we'll move forward. I don't like to say, well, I have to have it, I have to get the property back in order for these numbers to make sense. I'm generally not going to move forward on those types of notes.
Lorraine, can you buy notes in all 50 states, or where are you currently? Where are your connections right now?
So
could I tell you specifically, by the way, like, I want to buy notes in this city only?
You can, it may limit your ability to be able to purchase notes. I can't predict when the bank is going to sell a note in wherever, Ohio type of thing. So being specific is fine. Just have the understanding that it might take you a bit longer to get into the asset because you want to be in a particular area type of thing.
But the tapes that you're getting right now are all over the country?
Pretty much, yeah. And I mean, it's not, when I say all of the country, it's not to say that I'm getting notes in every area of the country every time I get inventory. It fluctuates. But at the moment, you did see one of the Wisconsin notes that I have another note in Ohio, and then I have another note in Indiana at the moment. So it varies, and a lot of it is just dependent on the numbers and if those make sense. Some of the popular states that I generally always see on the tapes are Florida, the Georgias, the Texas, PA. I see some Pennsylvania ones. Those are pretty popular. So yeah, those are some of the more popular states that I see on the tape. But yes, you do have the ability to buy everywhere. I will say though that some states are starting to get particular in terms of maybe having some licensing. And again, that's, another conversation or another detail to this. Not every state, and most of the states that even require licensing, you kind of have to be a big player. Like you gotta, probably be purchasing like 10, 50, 100 notes for you to really be on their radar. Not trying to deter anyone from getting licensed if you're doing this, but just to give a little bit of context. But yes, 50 states.
Cool.
Mm-hmm. So grab a little water. I got me talking up here.
How long you been doing it? Hi.
Hello?
Janet said, how long have you been doing it?
Oh, sorry, I was breaking in. I've been doing this almost 3 years now, I want to say. All the years. I think I lost a year during pandemic, but yeah, I think it's been about 3 years so far. 2.5, maybe 2. Yeah. I know I don't look it, right? No.
Wow.
So I don't I don't know.
That's pretty good. So, but you, I mean, you're doing a lot of other things, and this is one of the major thing that you do.
If I do a lot of different things, you said?
Oh. Yes, with the real estate, but notes is probably like one of your major things that you do with real estate.
Yes, this is my main strategy with real estate. And again, in understanding how taxes work and all of that stuff, I certainly welcome the diversification. So, picking up some rentals to offset the profits that you're making from the notes, because the notes is, at least if it's a performing note for the most part, that's straight profit. There's really, outside of, your business expenses, you're going to be paying taxes on that amount that you're making. So maybe to offset that, you have a rental that's providing you with depreciation, which creates a loss on paper. And this is just more of a tax strategy because that's just how my mind works. But something like that would be good to be able to offset. So yeah, this doesn't have to be your end all be all, but I do think it's a really great thing to add to your portfolio if you're interested.
Speaking of which, did you get the copy of my book?
I
need
did.
to
I'm sorry. I'm getting to it. I have to do some travel later on this week, so I will read it on the plane. I promise.
Perfect. Just make sure you have a lot of coffee because it might put you to sleep.
Oh, okay. Well, I mean, strangely enough, I guess I'm nerdy in the fact that I like tax stuff, for the most part. So it might not put me to sleep right away.
Good.
How about that?
Our CPA loves it. He's totally a tax nerd. So it's good.
What book are you talking about?
Liz and I actually wrote a book, and so we're in draft mode right now. We've sent it off to a couple of editors and a few friends to read for us and give us some feedback on it before we go to publish it. And it has to do all about tax saving strategies when selling rental properties. And so, Lorraine, with her tax knowledge, we thought would be a great person to actually read it and give us some feedback. So she's one of the people that got to preview our book.
Congratulations, you all. That's nice.
Yeah.
Oh, and the thing with it is there's a lot of good examples. So it's not just straight like trying to figure it out. So if you didn't like word problems in school, we're going right back to word problems. But when it's something that you do and you can plug in your own numbers, it's kind of cool. So I think that helped a lot breaking it up that way.
Liz, I don't even recognize that room that you're in.
I know, it's so different. And that's why, Lorraine, I love you to death. And I'm listening the whole time, but my daughter kept coming in the room and I was just like, I'm keeping it off. And you and I had a detailed conversation about it. But
For all of you that don't know, Liz is doing some major renos in her house right now, repainting and changing countertops and getting ready to sell her house.
And it's a hot mess, which is why I was late, because I forgot to turn my alarms on, but I was texting Marie, the washer, somebody put the soap on top of the washer, the liquid soap, and I put something in the dryer and it vibrated off and fell on the floor and all the liquid spilled out all over the laundry room floor. And we took the baseboards off and it's all in the freaking baseboard crack. And I'm like, what? How do you clean that up even?